Imagine your business brings in $4.5 billion in just 3 months. I mean, you're feeling pretty good about yourself, right?
Oh, absolutely. That is a massive amount of revenue. You'd be thrilled.
Right. But then you check your bank account at the end of the quarter and you realize you only get to keep like roughly 0.5% of it.
Ouch. Yeah, that's a tough pill to swallow.
Exactly. It makes you wonder, where did billions of dollars just vanish to? So today we are taking a deep dive into the first quarter 2026 earnings release from ManpowerGroup to find out.
It's a really fascinating document, honestly. Much more dramatic than you'd expect from a standard financial report.
It really is. And, if you're listening and wondering why you should care about some corporate financial document, well, it's because ManpowerGroup operates in over 70 countries and territories.
Yeah, they are placing literally millions of people into jobs every year.
Exactly. So their financials aren't just, a scorecard for Wall Street investors. They act as this real-time thermometer for the global economy.
Right. It tells us exactly who is hiring, who is freezing budgets, and more importantly, what the future of your own job security might actually look like.
It's like looking under the hood of a massive engine while it's driving down the highway. We get to see exactly which pistons are firing and which ones are just sputtering out.
That's a great way to put it. Today, we're going to decode that massive gap between the flashy headline numbers and the underlying reality of the global labor market.
Right, because I was looking at the top line of this report, and the contradiction is just completely wild to me.
It's definitely a head-scratcher at first glance.
Right, so in the first quarter of 2026, ManpowerGroup's revenues hit $4.5 billion.
Yeah.
That is a 10% increase as reported, or, well, a 3% increase if you adjust for currency fluctuations.
Yeah, solid top-line growth.
But then I look at the net earnings, the actual profit they take home, and
Yeah.
it barely registered. I mean, what happened here?
It's a massive drop. Net earnings plummeted by over 55% compared to a year ago.
55%.
Yeah.
Yeah.
They went from $5.6 million down to just $2.5 million this quarter.
Wow.
And to put that in perspective for investors, their diluted earnings per share fell from 12 cents down to just 5 cents. It looks like a severe bleed on paper.
That math is just really hard to wrap my head around. I mean, if you are bringing in $4.5 billion in revenue, how does your actual profit drop to just $2.5 million?
It sounds totally contradictory, right?
It sounds like me at an all-you-can-eat buffet. Like I'm piling a ton of food on my plate, but actually eating very little of it.
That's hilarious. But a better way to look at it might be like buying a massive, fully rented apartment building.
Okay, I'm tracking.
The rent checks are pouring in every month. That's your $4.5 billion in revenue. But your immediate profit is tiny because you've decided to spend almost all of it this month ripping out the walls to replace the 50-year-old plumbing.
Ah, I see. So your bank account is low today, but you're making yourself immune to future leaks.
Exactly. The hit to their earnings is entirely intentional.
Wait,
Yeah. ManpowerGroup swallowed a massive 46-cent per share cost this quarter, and that was due to restructuring and the launch of what they are calling a strategic transformation program.
Okay, so a massive internal overhaul.
Right. When a multinational corporation that has been, acquiring smaller companies and expanding globally for decades decides to suddenly integrate its operations, it is really expensive.
I can imagine.
They are consolidating offices, updating legacy technology platforms across 70 different countries, and just generally standardizing their back office operations.
Wait, let me get this straight. 46 cents a share for restructuring when they only reported 5 cents in actual earnings.
That's right.
So they spent nearly 10 times their net profit just on renovating the business.
They did. If you strip away those one-time transformation costs, their adjusted earnings per share was actually 51 cents.
Oh, wow. Okay, that changes the picture completely.
It really does. And that adjusted figure represents a 3% increase in constant currency.
Let's actually pause on constant currency for a second, because we hear that term thrown around in financial news all the time.
Sure, it's a very common metric.
I mean, it basically means we're grading their performance on a curve to ignore global exchange rates, right? But how does that actually impact the actual cash in their vault?
Well, think about it behaviorally. ManpowerGroup does a massive amount of business in Europe, which means they get paid in euros.
Right.
But they report their global earnings to Wall Street in US dollars. So if the US dollar happens to be unusually strong against the euro in a given quarter,
The money they made in Europe looks a lot smaller when they convert it back to dollars for the report.
exactly.
Yeah.
By looking at constant currency, We freeze the exchange rate to see if the actual volume of their business, like the actual number of human beings they put into jobs, went up or down.
And the reality is that core business volume actually grew by 3%,
Yes.
which totally shifts the narrative. I mean, CEO Jonas Prising actually noted in a report that this marks 5 consecutive quarters of year-over-year revenue trend improvement.
Right. It's a very steady climb.
Plus, they are targeting $200 million in permanent cost savings by 2028. So this isn't some struggling company trying to find clients.
Not at all.
It's a company intentionally draining its current profits to build a much wider runway for the future.
It's a highly calculated bet. I mean, they are stripping out structural inefficiencies so that when the global hiring market fully rebounds, their profit margins will be significantly wider.
Okay, so this corporate transformation perfectly explains that scary drop in overall earnings.
Yep.
But, if they are fixing the plumbing internally, it must be because the external environment is forcing their hand a bit, right?
Absolutely.
Because when you look at where that $4.5 billion actually came from, the global map is just incredibly fractured. I mean, some places are surging and some are basically falling off a cliff.
Yeah, the global job market is not moving as a single cohesive entity right now. The divergence is actually pretty severe.
So break that down for us. Where is the growth?
Let's look at the bright spots first. Latin America, which falls under their Other Americas segment, is absolutely booming right now.
Really? How much are we talking?
Revenues were up 19.4% in constant currency.
Wait, 19.4%. That is explosive growth for a region that size.
It's massive.
What is happening in Latin America that just isn't happening elsewhere?
It's driven heavily by nearshoring.
Okay.
Coming out of all the supply chain crises of the past few years, major corporations are moving their manufacturing and logistics hubs out of Asia and bringing them much closer to the United States.
Oh, right, because they want shorter supply lines.
Exactly. And that massive shift requires an immediate injection of flexible blue-collar labor to build the facilities, run the warehouses, manage the logistics,
And Latin America is perfectly positioned to capture a huge portion of that demand.
Spot on. And similarly, the Asia-Pacific and Middle East region is also showing strong demand. Revenues there were up 8.1%.
So the emerging markets and the manufacturing hubs are hiring like crazy right now. But then I looked at the data for Europe and the United States, and it paints a much, much darker picture.
It's definitely a more complex environment. Europe is stabilizing, but it's a mixed bag.
How so?
Well, France is ManpowerGroup's single largest market. Just France alone brought in over $1 billion in revenue for the quarter.
That's a huge chunk of the total.
It is. Their revenue trend there was technically down a tiny bit, like 0.3%, but management specifically called out sequential improvement.
Okay, so maybe hitting the bottom and starting to bounce back.
Exactly. And Southern Europe, particularly Italy, had a solid quarter, up 7.5%. But the real shock in this report, the part that really turns heads, comes from the United States.
Yeah, I saw this and could barely believe it. The operating unit profit in the United States fell a staggering 81.9%.
Yeah.
It dropped from $11.3 million down to just $2.1 million. I mean, how does the U.S. market fall off a cliff like that, while Latin America surges by nearly 20%?
It doesn't make any sense on the surface.
Not at all.
Well, to understand that disparity, you have to look past the geography and examine the underlying mechanisms of what kind of labor they are actually selling.
Okay, so it's not just about the location.
Right, because ManpowerGroup isn't just one monolithic brand. They actually operate 3 distinct business lines.
Right, I saw that.
You have the core Manpower brand, you have Experis, and you have Talent Solutions. Now, the core Manpower brand deals heavily with flexible, contingent, and commercial labor.
Basically, the blue-collar and temporary workforce.
Exactly. And that brand saw strong growth globally.
Which tracks perfectly with that nearshoring boom in Latin America we just talked about.
Yeah.
I mean, companies need workers on the warehouse floor today.
Precisely. But then you have Experis, which is their brand focused on professional and IT resourcing, and Talent Solutions, which focuses on permanent recruitment and high-level workforce consulting.
And those are the ones struggling.
Yeah. Those 2 brands are facing severe headwinds right now. The U.S. market is heavily indexed in white-collar tech, finance, and professional roles.
Ah, I see.
And right now, due to high interest rates and broader economic uncertainty, corporations have completely frozen those massive structural hires.
This perfectly illustrates the psychology of corporate caution for anyone listening. I mean, if you are navigating your own career right now, this data is telling you exactly how companies are thinking.
It really is a window into the boardroom.
Yeah. They are basically saying, we have essential work that needs to be done today to keep the lights on, so we will hire temporary or flexible help.
Right.
But we are way too anxious about the economy to commit to a full-time, permanent IT director with a massive salary and benefits package.
It is the ultimate wait-and-see approach. Companies are just hoarding their permanent headcount budgets.
Right.
So a market like the U.S., which relies heavily on placing highly specialized permanent professionals, sees this massive contraction in profitability.
Is there any sign of it letting up?
Well, the rate of decline in permanent hiring is narrowing a bit, meaning the freeze might be thawing slightly. But the overall corporate hesitation is still definitely the dominant force in the white-collar world.
Okay, so this corporate caution explains the massive regional disparities and that crazy drop in U.S. profits.
Yes.
But what's wild is that caution isn't just affecting how their clients hire. It's actually dictating exactly how ManpowerGroup handles their own bank account.
Oh, absolutely. They are playing defense.
Right. Because I was looking at their cash flow statement, and there is this bizarre movement of money. Their cash and cash equivalents dropped from over $871 million at the end of December to about $225 million by the end of March.
It's a huge drop.
That is a drop of nearly $650 million in just 3 months. If they are bracing for a tough environment in the professional sector, why are they bleeding so much cash? Did they just lose it in the sofa cushions?
No, they aren't bleeding cash. They are deploying it very defensively.
How so?
If you look under the financing activities section of that statement, you see the mechanism behind the drop. They made a massive $582.3 million repayment of long-term debt.
Oh, wow. So they just paid off a huge chunk of loans.
Yes, they are aggressively deleveraging the company.
But wait a second. If they are slashing costs and undergoing this massive transformation to prepare for the future, and we know they are heavily pivoting toward artificial intelligence, shouldn't they be using that $500 million to, like, buy up AI tech startups or fund massive expansions instead of just paying off old loans?
I mean, in a different economic climate, perhaps. But we are in a high interest rate environment right now. Holding debt today is incredibly punishing compared to, say, 5 years ago.
That makes sense.
By paying down over $500 million in debt, they are immediately wiping out massive future interest payments. They are basically building a fortress balance sheet.
A fortress balance sheet. I like that.
Yeah, if the global economy does take a downward turn, the companies that survive are the ones with the lowest fixed costs.
It's the corporate equivalent of paying off your mortgage entirely because you're worried your industry might face layoffs. You just want your monthly baseline expenses to be as close to zero as possible.
Exactly. And we are already seeing that defensive posture working for them.
Really?
In their SG&A, which stands for Selling, General, and Administrative Expenses, that was actually down year over year in constant currency.
Okay, so in behavioral terms, what does that actually mean?
It means they are spending less on office space, less on administrative bloat, and just running a much tighter ship day to day. They are systematically lowering their daily operating costs so that every single dollar of revenue works harder for them.
Wow. So they are really de-risking the entire business. They paid off the debt, they are shrinking their daily expenses, and they swallowed that bitter pill of the restructuring costs early on.
That's the playbook.
But you can't just shrink your way to long-term market dominance. Eventually, you have to go on the offensive.
Which brings us to the core of CEO Jonas Prising's strategy for the future.
The AI pivot.
Yes. With this clean balance sheet and the super lean operation, they are funneling their resources into a massive AI strategy. They're bringing new AI products to market designed to fundamentally change both the candidate experience and the client experience.
Okay, we hear AI constantly from literally every company on Earth right now.
Oh, it's the buzzword of the decade.
Right. But what does AI actually look like inside a staffing company? Are they having robots conduct the interviews?
No, it's much deeper than just slapping a chatbot on their website.
Okay, good.
Historically, staffing relied heavily on human recruiters manually matching keywords on a resume to keywords in a job description.
Which takes forever.
It's slow, it's biased, and it's highly inefficient. AI actually changes the matching engine itself.
How so?
They are deploying advanced algorithms that can actually predict talent shortages in specific regions before they even happen.
Oh, wow. predictive hiring.
Exactly. And they are using AI to assess a candidate's underlying skills and adjacent capabilities rather than just relying on whatever past job titles they had.
So, like, if a candidate has a background in complex logistics, the AI might flag them as a perfect fit for a burgeoning data center operations role, even if they've never worked in tech, because the underlying problem-solving skills are basically identical.
Yes, exactly. It automates all the heavy lifting of sourcing and screening, which drastically reduces the time it takes to fill a role.
Which is huge for clients.
For a client needing 100 warehouse workers in Latin America by tomorrow, that speed is invaluable.
And for ManpowerGroup.
It means their recruiters spend way less time sifting through thousands of resumes and more time actually building relationships and closing deals. It's a massive efficiency multiplier.
And it seems like management is incredibly confident that this pivot from defense to offense is going to happen quickly.
Very confident.
Because if you look at their forecast for the second quarter of 2026, they are anticipating diluted earnings per share to bounce back to somewhere between 91 cents and $1.01. That is a massive leap from the 5 cents they just reported.
It's a very strong signal to the market. Now, that Q2 forecast does include an estimated favorable currency impact of about 5 cents, and it assumes a 43% effective tax rate.
Sure, the financial caveats.
Right. But projecting around $1 per share proves that the executive team firmly believes the worst of the transformation costs are officially in the rearview mirror.
It tells us they didn't just burn the furniture to stay warm. They actually built a better furnace, and they expect it to start generating serious heat immediately.
The runway is totally clear. The investments in AI and operational efficiency are expected to start yielding tangible financial returns next quarter.
That is just a fascinating story, hiding behind what is basically a very dry spreadsheet.
It really is.
So to bring it all together for you listening, we started by uncovering the truth behind those headline numbers. That massive drop in profit wasn't a failure to find clients.
No, not at all.
It was a deliberate, expensive restructuring designed to strip out legacy costs and save them $200 billion over the next 2 years.
Exactly.
Then we looked at the fractured global map, which revealed a massive boom in blue-collar nearshoring in Latin America, which was sharply contrasted by a deep freeze in white-collar hiring in the United States.
Right, the tale of two economies.
Yeah, and it perfectly encapsulates the caution of modern corporations.
Yep.
They are willing to hire temporary help to keep the lights on today, but terrified to commit to permanent salaries for tomorrow.
And finally, we followed the money. Instead of hoarding their cash, ManpowerGroup aggressively paid down over $500 million in debt.
The workers' balance sheet.
Yes.
Wow.
They fortified their financial foundation so they could safely pivot their entire business model toward artificial intelligence, literally changing the very mechanism of how human beings are matched with open jobs.
Which really is the ultimate takeaway here. I mean, they spent the quarter tearing themselves down so they could rebuild as a fundamentally different kind of company.
It leads to a pretty profound paradox, actually, if you step back and look at the bigger picture.
What do you mean?
Well, ManpowerGroup's entire 75-year legacy is built on the concept of manpower.
Right.
The foundation of their empire has always been human labor, human intuition and recruiting, and human connections. Yet their stated path to surviving the future relies almost entirely on artificial intelligence.
Wow. The ultimate pivot from human intuition to algorithmic certainty.
Exactly. As they increasingly deploy AI to source, assess, and manage talent globally, how will the very definition of human resources change?
That's a great question.
When algorithms are deciding who is the best fit for a role based on invisible data points, where does human intuition actually fit into the hiring process? It is definitely something for you to think about the next time you submit a resume into the digital void. Are you being evaluated by manpower or by machine power?
Man, that is a haunting but essential question to keep in mind as the workplace evolves. Well, thank you so much for joining us on this deep dive under the hood of the global economy. Keep questioning the headlines, keep following the money, and we will catch you next time.